I've never seen before in my career. And I've talked a little bit about this, but it's worth mentioning to your listeners. Look, in my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And, and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently, we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional traders, like many thousands of dollars a year. He's saying, no, it's 25, 25, 25, 25, 25 gold, stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach, the bond king, saying, no, 66, what did he say? Jeffrey Gundlach said, 25% in gold, Monday morning, 25% in gold is not overweight. And then the 6,600 part, that's Jeffries. They used to be a primary distributor for all the world's mints. And they said 6,600 is their next target, at least intermediary target, for where they expect gold to go before it takes a little bit of a breather. You have massive institutional money, traders and analysts and chief investment officers speaking to the most sophisticated traders in North America, saying 25% of your portfolio in gold is not too much. I mean, that's just insanity, if you ask me. Goldman Sachs said, if 5% of the money comes out of the bond market because they fear that there is no, independence on the Fed anymore, that gold would go to 5,000 like that. Well, when you have Stephen Mirren sitting in the Fed, who it was Trump's advisor and the architect of the Mar-a-Lago Accord, he fills the vacated spot. What independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year. So when we talk about record highs around 4,400 gold and then it falling off and everyone's saying it's over, I find it disingenuous at best when you have these analysts saying this. And here we are back up above $4,100, and that shows the strength and the underlying support. So gold's held up because of central bank accumulation. And to me, that's what we've been saying forever. We've seen physical demand rising and global monetary stress increasing, all of the stuff that we talk about. But what I believe we are seeing, kind of what we were just talking about, is a slow motion global run on physical gold. And the pullback from those highs wasn't a breakdown, it was a consolidation. Catching its breath, not throwing in the towel. Pick your use.
Is a seismic shift in institutional thinking. For decades, 5% of a portfolio in gold was considered bold. Now, CIOs and analysts are openly recommending 25%. Gold is moving from a minor hedge to a central anchor in portfolios, a silent revolution most investors haven't noticed yet.
I look at it a different way, Jesse. I mean, I think what they're trying to do, if I'm going to guess, is to reshore manufacturing. And the only way you do that is to massively devalue the dollar. Look at Triffin's dilemma, which says as the world reserve currency, you will always have a net deficit in global trade because your major export's going to be dollars. The world needs more dollars than we can provide through trade alone. And so countries over time have to sell their currency to buy ours, weakening theirs, strengthening ours against those currencies, that is. And so over time, manufacturing flows to where it can be produced the cheapest. Vice President Vance has come out on White House letterhead saying, no, we can't do this anymore. Triffin's dilemma, it has been a subsidy for the consumer. It's been a massive hindrance for the producer. It's a broken system. We have to move away from it. Even the knucklehead that was Jared Bernstein, a true knucklehead, if anyone remembers him trying to explain how treasuries were created, he was the White House lead economic advisor under the previous administration. He did write a report called Dethrone King Dollar, where he says the same thing. Being the reserve currency is now a hindrance rather than a benefit. Now, if you are trying to bring back manufacturing, you have to have a weaker dollar. How do you get a weaker dollar? You let gold go to levels that no one can imagine, and I think you will see that. Now, you could argue Bitcoin too, but take a look at USA Tether as an example. USA Tether, which is already Genius Act compliant, Their CEO is a man named Bo Hines. Bo Hines was Trump's crypto czar until August. So the rules that Bo Hines was creating, he is now benefiting from. What is Tether doing? They have 12 billion in gold right now, more than they have in Bitcoin. About 8 billion they have in Bitcoin, according to their last numbers that just came out. They were just at the Beaver Creek Mining Summit as a company. Tether was, which is one of the biggest mining summits in the country. Again, talk about Chinese disintermediating the market. Now, Tether is. So let's just play this out. The Genius Act says that any time, and to your point, I think they're using the cryptosphere, if you will, to get to where they want to go. And I know that sounds kind of...
Where politics, crypto, and gold intersect in a way few discuss. The Trump administration's crypto strategies could be a clever way to artificially devalue the dollar, stimulate synthetic demand, and support U.S. manufacturing. It's almost like using digital assets as a national-level monetary tool, a bold experiment in reshaping the economy.
60% of this country has a literacy rate below a 6th grade level. 60% can't read past the 6th grade level and have no college education. AI is already kneecapping entry-level jobs, and they predict in 3 or 4 years, half of those entry-level jobs will be affected by AI. So if you don't make anything, and AI is changing the dynamics of the world, and your population is less educated than ever, yeah, you got some problems. So I do think if there is any nobility in what he is trying to do, if I'm right, it is to bring back manufacturing. And the only way to do that would be to revalue gold, to devalue the dollar, give up on the reserve status, as Triffin's dilemma cites. And besides, all these countries around the world, they want to trade in their own currencies. They want to determine their own fate. They want the strength or weakness of their currency to mean something, settling imbalances in gold. And I think we're coming around full circle to gold always being the center of the monetary system. In the BRICS nations, it will be a vehicle to settle trade and currency imbalances. Here, I think it's going to back the treasury market. To retain demand for the treasury market at the same time, they are loosening their desire or relinquishing their desire to maintain world reserve status. So we'll see. That's my thesis, and I've been saying it for a long time, and I believe it. We'll see how it plays out, because if we don't, our next generation and the one after that is in massive trouble, because, you don't live in the AI sphere or on Wall Street. Where are you going to make the money? And I think that's something people need to think about for a moment. And I do think he's trying to bring back manufacturing. This would be the only way to do it.
This is the generational warning. Beyond markets, AI, low education, and lost manufacturing capacity create a ticking time bomb. Gold isn't just an investment, it's a hedge against systemic collapse.